Stock Play of the Day is an educational program. Any statements made by Ally Invest employees are not intended to be or should be considered investment advice, a recommendation to buy, sell, or hold a security, or a recommendation to adopt an investment strategy.
Hello and welcome to the Stock Play of the Day. Today we're going to talk about protection strategies using the SPY. And we'll discuss, should we pass or should we play? Hello, my name is Brian Overby. I'm the Senior Options Analyst at Ally Invest. Okay, today we're going to look at protection strategies using some popular ETFs that track major indexes. So in general, instead of saying, should we pass or should we play, we're going to look at it as we can play because we choose not to pass overall. So what's one way that we can keep a portfolio going in this marketplace if you're nervous about where we're going to next? Now, as far as picking a direction on the market, I don't think I've ever been as befuddled about where I think the market is going to go to next, especially this week. Obviously, we have the war going on. Everybody knows about that. We also have a Fed meeting. And we have the marketplace is pretty much baked in a quarter point move by the Fed. Fed has not raised rates in many, many years. So let's start by looking at the S&P 500 index. The last couple of stock plays of the day, there wasn't too much to look at on the charts over the last couple of weeks. We don't see a lot of movement in the SPX, the IWM, the Russell 2000 index, the QQQs or the NASDAQ index. It's just been volatile, but the market's really gone nowhere. And what has kind of developed in the S&P 500 index, I have highlighted here. Let me start by saying this is a one-year chart. It's a daily chart. We have our 200-day, our 50-day, and our 20-day moving averages on the chart. And we actually, as far as the moving average is concerned, we have what's called a death cross. And that's where a faster moving average crosses over a slower moving average. And when it happens on a bigger moving average, like the 200-day moving average, and you have the 50-day crossing over it, usually carries a little bit more weight. So that is not a good sign that the 50-day has crossed over the 200-day. But if I just go down and I look at that pattern that we have, it's called a wedge pattern. So if I was forced to pick a strategy, right now we have the VIX index. We're going to talk a little bit about that. Right north of 30, right around 31%. It's actually down a little bit today because once again, we have a fairly strong up move after a fairly strong down move, and we just keep going back and forth with that, and not even from day to day. Sometimes it's from the open on the market to the close of the market. The swings are extremely wild, but the market's going nowhere. And because of that, we've kind of developed this wedge pattern in the S&P 500 index. And we're looking to break out of that wedge. Either going to break to the downside, which I'm trying to highlight here with the bottom side of my wedge, and on the top side. If we get that movement, we get that breakout. And with the Fed speaking this week, one of the things that I think the market wants is just the news to be done. They want some relief from this concern about what the Fed may say after they announce the rate hike. Now, not a given. Mr. Powell did say last week that he's supporting a quarter point move to the upside. The Fed Watch tool on the CME, the Chicago Merc Exchange, has basically said there's only about a 2% chance that it's going to be larger than a quarter point move, but it's more so about how aggressive they're going to be into the year end. A lot of people are anticipating 6 or 7 rate hikes over the year. I think they would have liked to came out and maybe even raised close to a half point But because of the global political concerns that are dealing with the war, they're kind of forced to move a little bit slower in this marketplace. But we do have inflation. Inflation is a big concern in the markets. So, to go back to my original statement and why I'm talking about this, we have the wedge pattern. We have the VIX trading right around 30%. I could actually see it higher than that, but we'll keep it right where it's at. And so I think implied volatility is actually lower than it needs to be, considering the risk of news that could come out at any point in time about the war. They announced a ceasefire that would probably be good to the upside. They announced that Russia is taking over a capital or a major city. That could be bad to the downside. So there's just a lot of potential news out there that could drive the SPX out of this wedge pattern, either break up to the upside, break out to the upside, or break down. All right, so I'm going to highlight this trade in the options playbook because if my hand was forced and I had to make a play in the SPY, which is what we're going to look at today, the S&P 500 index, the ETF that tracks the S&P 500 index, I would look at buying a long straddle. And a long straddle is just buying a long call and buying a long put. Now, that's a very risky trade, especially with the VIX right around 30% implied volatility. So you're paying a lot of juice, to use that technical term, for those option contracts. But that would be a strategy that I would consider. I'm not making that as a recommendation. So overall, and whenever we talk about trades on the stock play of the day, we're just trying to learn. It's not meant to be a recommendation in general about any of the underlying stocks that we're looking at. So a form of a long straddle is to actually buy protection on your portfolio. If I am long a stock and I buy a put, I would prefer that the underlying market went up on that stock because I have unlimited upside. But on the downside, I have a protected put, which actually gives me substantial downside protection. It's a little bit like a long straddle in that if I have that put, I have some protection to the downside, but I really want the market to go up. So it's not much different than taking this position. Now, it's not exactly the same. They're not synthetically the same type of strategy, but that's the concept. If you're nervous about the market, one thing that you could do right now is just sell your stocks and get out. Maybe go out and buy some bonds. That would be very nervous in the marketplace. Where if I'm considering the volatility and where the market could go next, one way that I could play this is to use an ETF that, like the SPY, if I have a portfolio made up of a lot of SPX stocks, if I have a lot of tech stocks, maybe I consider the QQQ. If I have a lot of small cap stocks, maybe I would consider using the ETF, the IWM. And I would apply the rules that I'm going to talk about today to try to protect my portfolio, give myself a little bit of protection on the downside to allow me to remain long the market by owning the stocks inside my portfolio. So we talked about pure protection. Let's say, for example, we had Apple stock. And a while back, going into the year end, I talked about strategies to protect Apple as we went into the new year. So we looked at things like a collar. We looked at things like protected puts. We looked at things like covered calls. So that would address individual stocks. And one of the problems with buying puts on individual stocks when you have a portfolio of stocks is each and every stock, it's fairly expensive to do, and it would be quite costly. Now, if you have one stock that you're scared about, or just in particular, then buying a put is not a bad strategy on that one stock. But on a portfolio basis, once again, it's fairly expensive to do. So how can we lower that cost? Well, we're going to still look at the protective put as far as the strategy is concerned. So let me run back and click on protective put inside the options playbook. And this outlines buying a put on one stock. I am going to look at it on a portfolio basis. Now, though this is not an exact science by any means, and if you're buying protection using indexes or ETFs that track indexes, you have to be fairly certain that your portfolio looks a lot like that index, because if you're buying that protection, then it's not going to help you much if your stocks that you own are not in that index. It's pretty obvious. So selecting the correct ETF is important. And we're going to start by just looking at one in the SPY. So let me go to the Ally Invest chains, and we see here in the SPY, scroll up a little bit, fairly decent move, 1.3% to the upside. We're up $6. This is the ETF that tracks the S&P 500 index, one of the most liquid ETFs in the world. 423 is a nice round number. That was the last trade. We're going to go out till April Fool's Day, because right now insurance is fairly expensive, because as I mentioned, the VIX is trading right around 30%. So you have to pay for some protection. I feel like it could be a little higher. If the VIX is high, insurance is going to be expensive overall. April 1st, 17 days away. We're going to go down a couple percentage points. Right now we had a move up of 1.4%. If we look at about a 2% move to the downside, just like when you're buying car insurance, let's think of car insurance or homeowners insurance, you always have a deductible. You take on X amount of risk, and that reduces your total premium. We're going to take that same concept on our portfolio insurance. We're going to say the VIX, the SPX is right around 423. A couple percent move would be right around $8.50, down to 413. That is going to be our risk to start with. That's our deductible. From 413 on down, we're going to own a put option that's allowing us to take the SPY and put it to somebody at 413. Now, if we have a portfolio of stocks, we're really not going to be putting the portfolio of stocks to anybody. We're just going to be selling our put option if the market goes down and help offset a little bit of the risk that's involved in our portfolio. So the question then becomes, how do we determine the amount of portfolio protection one SPY put might provide? And to do that, we got to go back up to the quote and look at where the SPY is at. Now, you can get fancy with this, and there's something called beta weight your portfolio to try to see how the deltas would match up, and you'd get kind of technical on it. This is not an exact science to me. I'm going to go out the next 17 days because I do think that the news cycle over the next 17 days is going to add some volatility to the marketplace overall. And so I'm nervous about that. Not to mention it expires on April Fool's Day, April 1st. So that's got to make you nervous too. So the 413 strike put is trading for, and I'm going to highlight it right here, $7.20. That means it's going to cost me $720 if I want to buy one put option. That put option represents 100 shares. And so to come up with a guesstimate on the portfolio protection, you take 100 times 4, we'll round it off, 423, and you're going to come up with $42,300 worth of portfolio protection. So one put should protect, if I have a portfolio that looks a lot like the SPY, it should protect approximately $42,300 worth of stocks. All right. So let's say I had a $100,000 portfolio. And like I said, this isn't an exact science. Then you're going to have a tough decision. If you have a $100,000 portfolio and I buy 2 put options, we're talking about I'm going to round off here, around $84,000 of portfolio protection. But if I buy 3 puts, well, now we're looking at about $120,000 worth of portfolio protection. Obviously, each put is fairly expensive, and so I have to consider, do I want to kind of overinsure my portfolio, or do I want to underinsure the portfolio? It's not an exact science. It's wherever you feel comfortable with. But if I look at the cost of this put, and I'm going to scroll down to the workbench right now. Right now we have a very tight market, just like we usually do in the SPY. We're 721 on the bid, 725 on the ask. Midpoint is 726 on the ask, 725 at the midpoint. I'm going to put this in the right rail, and you have to consider that we're protecting a portfolio of stocks. Now, on the downside, just like on your homeowner's insurance, if you lose your house, very rarely do you get the full amount back of your house. You're usually a little bit underinsured, and a lot of insurance agencies won't even let you buy too much insurance because they don't want to incentivize you to basically start a fire on your house, right? You can't overinsure your house. In theory, at least insurance companies don't really want you to do that. So keep in mind that as the portfolio goes down, we can overinsure our portfolio, but a lot of times on the downside, you're not going to get back the exact amount that you lost. And also we have a deductible. Our insurance policy doesn't kick in until the market's gone down approximately 2%, right at that 413 level. Okay, so if I had a portfolio of $100,000 of stocks that look like the SPY, I would consider coming in and buying to open, and I'm going to use the April. Now, I'm sure there might be a lot of questions, and by the way, put your questions in the chat box, like why did you decide April 1st? One of the things about portfolio protection on stocks versus buying homeowners insurance, it's a lot more expensive. The odds of your stocks going down versus your house burning down is a lot higher. So you got to pay for that. So ideally, if I'm really long-term bullish, let's say I'd like protection, or I was considering protection for the next 6 months, well, I might consider just selling my stocks and buying back 6 months later. That might be my alternative. Why? Because the insurance going out 6 months in time with the volatility index trading right around 30% is going to be really expensive on a portfolio basis. So I'm looking at buying insurance, and if I'm buying puts on an individual stock, if I'm doing this strategy like I'm talking about in the SPY, I am considering going out 2, 3, 4 weeks in time maximum, because I just need to get through this little sketchy period in the marketplace. That's my approach to it. If I'm really long-term bearish on the market, then I just want to get out of the market. I just want to sell some stocks. I want to maybe see a rally, sell into the rally, generate some cash. That would be another strategy to do. Market right now is up about 2%. Maybe find a couple of stocks that have done well today, sell some of that. Bring in some cash, be prepared for a downturn if you're truly bearish on the marketplace. This is a strategy that means I'm bullish, but I'm nervous. And that's the outlook that we're taking here by buying portfolio protection using the SPY. So $100,000 portfolio, you would decide, am I buying 1, or am I buying 2, or am I buying 3? I'm going to put 3 in here. All right. And that should protect approximately $120,000 worth of portfolio stocks that would be in the S&P 500 index. The limit price is $7. We'll put it at, $7.16. We'll make it $7.16. It's where the market's at. And I would pay the ask on this. In the SPY, trying to split the bid and ask on 2-cent wide markets isn't really worth it, but I always would put a limit order in. It's going to be a net debit of $7.16. That means for 3 contracts here, we're looking to pay $7.16. I put 15 in there. $7.16 for each put. So we're multiplying that by 3, or on a dollar basis, you're multiplying that by 300, and you're adding the commission in. You always got to remember that we still pay commissions on option contracts, so you're going to add the commission in on that. And that is going to be my protection, i.e. my insurance policy on my portfolio. Now, can I do this on a different portfolio? I've already mentioned some of that. I'm going to look at the QQQ next and say, yeah, I can. So once again, the not perfect math would be that if I had mainly tech stocks, a lot of NASDAQ stocks, I might consider the QQQ. It's trading at 325. So every put, you're looking at $32,500 approximately of portfolio protection. So if I had a $100,000 account, 3 puts might get me right on that number. We're talking 30. So we said 32.5 times 3. We're looking at about 106. 106.5, so $106,000 by buying 3 of them. If I wanted to get a little bit of overprotection, I'd buy 4. If I'm just not quite as nervous about the market, I would buy 2. And that's the way I would approach the QQQ. I still would consider doing a shorter time frame as opposed to a longer time frame. And bluntly, if April 1st comes around and the market is still just doing this volatile thing where it's down 2%, up 2%, sometimes within the day it will move 4 or 5%, but it's still not going anywhere. Well, then I might consider maybe buying another put going out 2-3 weeks in time. And that's the way that I would look at protecting a portfolio of stocks that would allow me to be in the marketplace and not sell my stocks and panic sell them with the market down at these levels right now. Now, the other idea is just to say, I'm just going to remain long stocks, right? And I'm going to ride it through the volatility, and hopefully all these geopolitical concerns will be over with by the end of the summer, and we'll see a rally in the marketplace. That's always feasible way to look at it. So I've given you a lot of options here. I'm sure there's a few questions, so let me run to the questions right now, and we'll check out a couple of the questions in here. It looks like William Mitchell. Thanks, William, for your question. Other than bringing the initial cost of the premium down, how does one determine beforehand when to use an option spread versus simply buying an option outright? That's a very good question. If I have a protective put, what William is mentioning is buying a put spread. So I'm going to run to the option playbook, but we'll stay right here for the second. And I'm going to highlight something in the options playbook. Give me a second to get there. And we'll just look at a long put spread as opposed to buying a put outright. So long put spread right here. There it is. Okay, I have it. Okay, now let's show the long put spread. Okay, if I buy a put, I have substantial downside protection. In other words, I'm saying from our 413 strike that we looked at in the SPY, I want protection all the way down to 0 from 413. That's what a long put will let me do. If I do a long put spread, I can say, well, I only want to protect, let's say 10 points, from 413 down to 403. and then my insurance would only protect me in that level. That's a long put spread. Guess what? That's going to be a lot less costly to do. I would apply the same math to try to determine how many long put spreads I'd want to buy, but this is an alternative, and it's a cheaper alternative. Doesn't give you the full-blown protection, but it does give you that opportunity. Now, one of the things about a long put spread is they don't max out until you get closer to the expiration date. We've talked about that a lot on the stock play of the day. Just on the long side, looking at long call spreads, picking your time frame is much more important. But this is an alternative to just buying the put outright, and you can lower your cost. All right. So, Raweye, I guess that's how I'm gonna say it. I'd take a stab at that username. Says, hello, I'm glad to be on the Stock Play of the Day live. Well, that's awesome. Thanks for stopping in. And if we have any other questions, now is the time, but we're running up to the 12:30 stopping point here on the Stock Play of the Day. But if I look at portfolio protection, and I just think of options, a lot of people think of options just as pure speculation. As far as the market is concerned, this is the one time where I really am not excited to try to pick a direction in the marketplace. I could pick some stocks, and another strategy that's feasible to think about is selling puts to buy stocks, or selling puts on stocks that I wouldn't mind buying if we do get a dip lower. We're getting a lot of premium. We have some juice on the overall market because we see the VIX up around 30%. And with that in consideration, if I got a couple of stocks that I'd like to cherry pick in the marketplace, think about selling a cash secured put. And I'm going to highlight that one last here. And this is selling cash secured puts on stocks I want to buy. These are all protection strategies to me. Even though I'm looking to buy a stock, I'm targeting a point below the marketplace. And I would be on a stock that I feel strong about and say, if it gets to this level, I wouldn't mind buying more. And if not, I'm going to at least collect the premium. Now, on a cash secured basis means that I have enough money to buy 100 shares at that strike price. And you might want to consider these type of strategies. I think it was time. We've been so bullish on the Stock Play of the Day overall because the market has been bullish going into this year. Obviously, now there's a lot more concerns in the marketplace, and inflation is probably one of the biggest ones. All right, so let me check the last call for questions. We have time for one more here. Did we buy against the market momentum? Did we buy against the market momentum? All right, and if we're saying did we buy puts, I don't mind buying puts on an up market. One of the reasons why, so the market is up a couple of percent today. One of the things that happened when the market went up is that the VIX came down, right? So I'm going to run to the VIX dashboard real quick and I'll show you that we see the VIX right now down 1 point or about 3%. The VIX chart is right over here. We're been hanging right around the 30% range. Now, normal volatility, this is a 1-year chart. Here's the 200-day moving average, is right around that 20% level now. That is, to me, it's a mean reverting index. The 200-day moving average is a slow moving average. And the marketplace is kind of saying, well, right now in this day and age, that would be considered normal volatility. We start coming down to the 20-day and the 50-day. Eventually, the marketplace usually goes back to the mean. And as you see here with all of our moving averages, how many more times that the market is just hanging within those moving averages. So, market up, I don't mind buying puts because I can get them a little bit cheaper today. So if I am nervous about the marketplace, we talked about the wedge pattern. We got the Fed that's going to be meeting this week. And the biggest concerns I think the marketplace has is how quickly they might want to continue to raise rates as we go into the end of this year. And that's going to be it for this edition of the Stock Play of the Day. Please click subscribe, ring the bell, and I will be back this Friday to talk a little bit about this protection strategy in the SPY. Thanks for coming, everyone.